If you're getting ready to retire and wondering how to create income from your savings without running out of money or triggering unnecessary taxes, you're not alone. Creating your own paycheck in retirement is one of the most important and often misunderstood parts of financial planning. And it's not just about choosing which account to pull money from. It's about coordinating your withdrawals with guaranteed income, tax rules, required withdrawals, and insurance strategies that protect you from the biggest risks you'll face in retirement. So, in this guide, we're going to walk through how to withdraw retirement funds in the most tax-efficient way possible. We'll show you how to integrate guaranteed lifetime income from annuities, protect your future with insurance, and avoid the common tax traps that can quietly erode your savings. We'll also explain what required minimum distributions are and how they impact your long-term income strategy, because the IRS has rules and you'll want to work with them, not against them. Let's start with the basics. When you retire, your regular paycheck stops and you have to start generating income from your own savings. That usually means pulling money from your investment accounts, things like brokerage accounts, traditional retirement accounts, or Roth retirement accounts. But deciding where to withdraw from first can have long-term consequences. So pulling from the wrong account can increase your taxes, shorten the life of your portfolio, and even raise your Medicare premiums later on. Take Rick and Anna as an example. They're both 60 years old and planning to retire in 2 years. They have $500,000 in total retirement savings. When they reach age 67, Rick will receive $2,500 a month from Social Security, and Anna will receive $2,200. That gives them a strong foundation, but it still falls short of their goal, which is to have about $8,000 a month to fully cover their lifestyle in retirement. To help fill that income gap, Rick and Anna added 2 annuities to their plan. Rick used $200,000 from his traditional retirement savings to purchase a fixed index annuity that includes a guaranteed lifetime withdrawal benefit. That annuity will pay him $1,500 a month for life, starting at age 65. Anna used $100,000 from her Roth retirement account to purchase a Roth funded annuity. That annuity will pay her $900 per month, tax-free, for life, starting at age 67. And here's what makes these annuities especially powerful. Even if the account value drops to zero, the income continues for the rest of their lives. That's what a guaranteed lifetime withdrawal benefit means. The annuities become a personal pension. They don't fluctuate with the market, and the income is guaranteed no matter how long they live. Once their Social Security checks begin and the annuity income kicks in, Rick and Anna will have about $7,100 a month in predictable income. That's more than 88% of their goal. It means they only need to pull about $900 per month from their savings to close that gap. And that opens the door for powerful tax planning. So how do they decide which accounts to pull from first? It helps to understand the tax treatment of each account type. Their taxable brokerage account has $100,000 with $50,000 in long-term capital gains. If they sell these investments while their income is still low in the early years of retirement, they can pay little to no capital gains tax. That's because married couples filing jointly can take advantage of favorable capital gains tax brackets. Selling from the taxable account early allows them to access cash with very little tax consequence. Next is their traditional retirement account. These accounts grow tax deferred, meaning they didn't pay taxes when they contributed the money. But every dollar they pull out in retirement is taxed as ordinary income. And beginning at age 73, the government requires that you start taking money out of these accounts each year. These are called required minimum distributions. The amount you have to withdraw is based on your account balance and your age. And if you fail to take the required amount, you'll pay a penalty of 25% on the amount you should have withdrawn. Even if Rick and Anna don't need the money from their traditional accounts at that age, they still have to take the withdrawals and pay taxes on them. This can cause a sudden increase in taxable income, which can raise their tax bracket, increase the amount of their Social Securities that's taxed, and even bump up their Medicare premiums. Their Roth account works very differently. With a Roth, they already paid taxes on the money they contributed. The account grows tax-free, and all withdrawals are also tax-free. And unlike traditional retirement accounts, Roth accounts are not subject to required minimum distributions during the original owner's lifetime. That makes Roth accounts incredibly valuable for long-term planning. You can let them grow, use them for emergencies, or pass them on to heirs with minimal tax impact. So, What's the best withdrawal sequence? In most cases, including Rick and Anna's, the best strategy is to start by withdrawing from the taxable account, then move to the traditional retirement account, and finally tap into the Roth account last. This approach allows them to manage their taxable income carefully, take advantage of low capital gain tax rates, and preserve the tax-free growth of their Roth for as long as possible. This sequence also gives them an opportunity to convert some of their traditional retirement savings into Roth while they're in a lower tax bracket before required minimum distributions begin. By doing these Roth conversions early, they reduce the size of their traditional account and therefore reduce the amount they'll be forced to withdraw later. This helps control taxes, protect their Medicare premiums, and create more tax-free income in the future. And all the while, their annuities are doing the heavy lifting. Rick's annuity provides a stable $1,500 per month, and because it came from a traditional retirement account, those payments are taxed as income, but they're spread out predictably. That annuity income may also count toward his required withdrawals, depending on how the annuity is structured. Anna's annuity provides $900 a month completely tax-free because it was purchased with Roth dollars. That income never raises their taxable income and doesn't count against any income thresholds for Medicare or Social Security taxation. To complete their plan, Rick and Anna added a hybrid life insurance policy. This policy includes both a tax-free death benefit and long-term care protection. If either of them needs nursing care or home health care, the policy gives them access to benefits they can use without depleting their savings. And if they never need care, the full death benefit will go to their beneficiaries. It's a flexible way to protect against one of the biggest unknowns in retirement, future healthcare expenses. The bottom line here is this: when you retire, your money needs to do more than just sit and grow. It needs to provide income, avoid taxes, and support your lifestyle, and adapt to the unknown. If you pull from the wrong account too early or miss the chance to convert at a lower tax rate, you may face higher taxes, higher Medicare costs, and a shorter timeline for your portfolio. But when you take a structured approach, starting with taxable accounts, layering in guaranteed income from annuities, managing your traditional and Roth accounts strategically, and protecting yourself with insurance, you create a retirement income plan that's built to last. Even if markets go down, even if you live longer than expected, even if healthcare costs rise, you have the foundation to stay on track. If you're ready to build your own retirement income plan using strategies like these, visit the Annuity Expert to explore options for guaranteed income, Roth planning, and insurance that can support your goals for the next 30 years and beyond. This isn't about picking products. It's about building a plan that supports your life, your values, and your financial future.